What's up everyone, and welcome to Jayconomics. My name is Jay and it's a pleasure to meet all of you. On this channel, we take a look at anything related to finance with a strong focus on investing. So if that sounds like something you want to be a part of, then please consider subscribing and liking this video to help me on my quest to befriend the big, bad YouTube algorithm. What's up everyone, and welcome back to Jayconomics. In my recent videos, I've been harping on due diligence and researching your stocks before you buy them. Well, today I'm going to discuss one of the most important and often overlooked aspects of analyzing a company: share structure. Before we get into it, if you want to grow your portfolio exponentially, be sure to check out our Smart Money Squad Patreon. There are various tiers for your goals and budget. You'll get my buy and sell alerts instantly, my weekly watch list and entry points every Sunday, and access to my stock master list. This document tracks my entire YouTube and Patreon performance and is basically just a way to be fully transparent. Speaking of which, the master list also reveals which stocks I've bought and sold, which ones I'm currently holding, and how much money I currently have invested in each stock that I hold. We're also quite active on Twitter, so follow us there at therealjayconomics. So make that thumbs up turn blue and subscribe if you're new. It really helps the channel grow. And now without further ado, let's get into the video. Share structure can be complicated to understand, especially with small cap companies like we cover on this channel. One of the first things to do when researching share structure is to go to the company's investor website. Also, you can check recent press releases too, as sometimes the company will put out the updated share count after a certain company action. Now, one thing you don't want to do is you do not want to trust data on sites like Yahoo Finance, StockTwits, etc. when it comes to share structure. This data is often incorrect and can be completely misleading in your analysis. So make sure you got the right numbers and you're looking in the right official places. If you're investing in a stock, you must know how many shares they have outstanding. Shares outstanding are the shares of a corporation that have been authorized, issued, and purchased by investors and are held by them. Shares outstanding directly impacts the company's market cap and their EPS, or earnings per share. The more outstanding shares there are, the more the company will need to earn to increase their EPS. A low number of outstanding shares means the company will have more flexibility to raise capital and increase shareholder value. As a rule of thumb, I start to get a little bit concerned when stocks that are under a $200 million market cap have more than 100 million outstanding shares. When this is the case, it's important to be extra cautious and really do your due diligence onto why this is. Obviously, the lower this number, the better it is for shareholders. When a company needs to raise money, sometimes they will issue new shares, increasing the number of shares outstanding. Share dilution is normally seen as a negative for investors. Because why? Well, because it devalues the shares they have already invested in. This is not always the case though, and I actually disagree with this idea most of the time. Why? Because sometimes a company issues shares to fund growth. When used wisely, issuing shares can be a great way for companies to fund their growth and deliver value to shareholders in the longer term. Raising capital during a bull market is a very smart move by small cap companies, and I actually see this as a good thing. If a company you're invested into raises capital at $10 per share, let's say, at its peak, and then the stock drops to $6 or $7 when a bear market hits, well, what do you think would have been more beneficial for the company, and by extension, you and other shareholders? Another point I want to stress here is if we have a prolonged bear market, it's vital for these small caps to have enough cash to get through the downtime. Cash is king, and so I make sure that with any large investment that I make, the company has enough capital to fund their growth, survive any downturn, as well as continue business operations without any delays. You may have heard people talking about the term float. The available float is the number of shares publicly owned that are available for trading. This number can be found by looking at shares outstanding and subtracting insider shares. The float has a direct impact on liquidity and stability in a stock. If the float is small because a large portion of the shares are held by insiders, I actually consider that to be a very good thing because we can see explosive moves when catalysts are presented. Companies are required to report members who have more than 5% of their shares. What I really like to see is insider ownership around 15% at the very least, and I really like when insiders are actively buying on the open market because that's going to show extreme confidence in the growth from that point and that valuation. I think this is especially important in small caps and penny stocks. When you are investing in a hyper growth company, you want the leaders to have skin in the game and be confident with the direction they are leading the company. The last thing to look out for is fully diluted shares. Companies will sometimes fund their growth by issuing options and warrants. A company with a small amount of shares outstanding could have many options/warrants that could lead to significant dilution down the road. So, how do you apply all of this information? Well, first of all, it can help you understand your potential return on investment. The market cap is shares outstanding times the stock price. In the picture you see on screen, you can see what you would need the stock price to be if you wanted to double your money. Let's say the market cap was $200 when you first invested, and you wanted to double your money. Well, you're going to need the price of the stock to go from $2 to $4. You must always remember that the number of shares outstanding has a direct impact on price and market cap. Since small cap stocks issue shares to raise money, you must stay up to date with shares outstanding. If your company issues new shares, you should immediately research how many new shares they issued and how they plan to use that money. Now, I want to show you the share structure of a couple companies that we have previously covered on this channel. So the first two companies that stick out to me are ESC Entertainment and Greenbankcapital. Their shares outstanding are below the 100 million mark I mentioned earlier, with ESC's being well below. Greenbank's share structure also looks very clean currently, but we will be keeping a close eye on them as we know that they plan on executing their call option on Stamineer, so this will likely change. However, for now, I can't stress this enough, even if you like the current share structure, you always have to be vigilant and keep an eye on this. Both companies also have very high insider ownership and a low float. Windfall Geotech has just under 100 million shares outstanding. Now, this does not overly concern me at all. This company is at the very beginning stages of their growth. So once again, I will just keep an eye out. In terms of Peak Fintech, I am very happy with their share structure currently. The game starts to change a little as you get over a $200 million market cap, and Peak is in a very good position for growth. One of the most solid, stable small cap stocks in the market right now. And now let's take a look at an example of a terrible share structure, okay? And this is AITX. This is a company that I like. However, their share structure is completely brutal and needs to be fixed in order for the stock to reflect the business. Now, in a bull market, this wasn't as much of a problem. However, in a bear market, this becomes a big issue. Okay, so here you see 3.5 billion shares outstanding for AITX, and this obviously is extremely high, especially when comparing to the other ones that I've shown on screen. Now, AITX has had lots of dilution, and when it's this extreme, I would suggest always taking a very close look at what's going on. Now, this is not a knock on AITX in the present day because I know that the CEO, Steve Reinhardt, has done a phenomenal job of renegotiating some old toxic debt and slowly moving in the right direction to bring shareholder value. However, the history here is ugly and this can't be ignored. And to that note, lots of these OTC stocks that are only listed on the OTC. Okay, so this is not to be confused with the Canadian small cap dual listed stocks also on the OTC. So for example, like Peak, Windfall, Greenbank, ESC, these are all Canadian small cap stocks that are dual listed also on the OTC. Okay, so when I say OTC only, this is not the companies I'm talking about. Okay, so just keep that in mind. Now, you have this kind of issue on the OTCs all the time, which is why you need to stay on top of things as an investor and consider the risks and overall situation for any company that you're looking into, because like I said before, share structure has a great impact on stock performance. Again, not to be confused with company performance, two different things. Again, when we're in a bull market and things are just flying, well, this is not that big of an issue. I mean, it will over time, but during the short term, it's not really that big of an issue. However, during a downturn in the market like this, in the growth and tech and OTC sectors like we've been seeing, well, this is especially true because stocks that have bad share structures and that are very overvalued and have run on hype, these are the ones that will be hit the hardest. A time like this is when you want to focus on undervalued companies, undervalued stocks that have beautiful share structures. And now, taking this information into context, I think that you'll understand why I think greenbankcapital, Cloud9 Web3 Technologies, and ESC Entertainment were such great purchases for me, and why I've pretty much consolidated my portfolio to match these three. Now, putting into context what I just said, I think you could take a look at yesterday's video in which I revealed my top 3 stocks, which make up 85% of my entire stock portfolio. And I think you could take a look at their share structure and put everything together and kind of understand what I mean. In the case of Greenbank and Cloud9 Web3 Technologies, I think that both of these companies are heavily undervalued at current levels, and this is why those two represent now 65% of my entire stock portfolio, as I did add to both positions today. And ESC, which wasn't undervalued per se, but I think that it's an extremely strong play in one of my favorite sectors with an amazing management team, and I think that it will bounce back very strongly. So that wraps it up for today's episode. I hope you guys enjoyed this video and that it gave you a good insight into share structure and how this impacts stocks. And guys, if this video brought you some value, then please hit that like button for me, as it really does help the channel a lot. And if you want more content like this, then don't forget to subscribe and turn on that notification bell to be notified when any new video comes out. And of course, check out the Patreon if you want access to all of the perks, like our awesome Discord and access to my stock master list. This document tracks my entire YouTube and Patreon performance and is basically just a way to be fully transparent. Speaking of which, the master list also reveals which stocks I've bought and sold, which ones I'm currently holding, and how much money I currently have invested in each stock that I hold. On top of all of this, you'll get access to all of my new stocks and new plays in a timely fashion and much, much more. And until next time, take care and invest smart.